This week was, of course, dominated by the conflict in the Middle East and what it means for oil prices as well as rates. So, starting there, the Strait of Hormuz, which carries about 20% of the world's oil supply, was disrupted by military action against Iran. Oil prices jumped significantly over the course of the week, and that really matters for rates because rising oil prices raise inflation fears, and inflation fears push mortgage rates higher. Bonds, which would normally benefit from chaos because people basically are looking for a safe haven, did actually get worse this week because of those inflation concerns. The situation's changing really frequently and obviously causing a lot of volatility. The U.S. has offered to escort ships through the strait and does seem confident that the disruption is going to resolve quickly. Maybe it does, but until it does, oil prices are driving the rate market more than really any other economic news. And the frustrating part is really underneath all that, the other numbers we got this week were actually really good for rates. And the jobs report was one that we've been waiting for. The BLS finally showed what the other reports have been pointing to for months. We saw 92,000 job losses in February, and that was against expectations of 50,000 job gains. The two prior reports were also revised lower by another almost 70,000 jobs combined. And the household survey that showed 185,000 job losses as well. Unemployment ticked up to 4.4%. And the amount of time people are spending on unemployment hit a 4-year high, just again, meaning people are struggling to find new work once they lose their job. And without the Iran situation, that report alone would have really likely pushed rates meaningfully lower. The job weakness is not new. It's been building and we've been talking about it. But the Fed members, who keep calling the labor market solid, are working off numbers that don't really reflect what's actually happening in real time or what's likely to happen in the future, especially with everything going on with AI. There are a few other things worth noting this week. That's one of the lenders I work with did launch improved pricing on eligible refinances through March, as well as a $600 appraisal credit on purchases through April. Good timing if you've got somebody on the fence. But also, trigger lead restrictions officially went into effect this week under the Homebuyers Privacy Protection Act, and that is a big win for consumers who've been getting bombarded after applying for a mortgage. As of the 5th, the mortgage trigger leads should be significantly restricted. Credit bureaus can no longer freely sell borrowers' information after a mortgage credit pull. That is, unless the lender already has a relationship with the consumer or the consumer's explicitly opted in. Consumers should get far fewer unsolicited calls, texts, and mail from competing lenders after applying for a mortgage, which should help reduce confusion and spam during the home buying process. I'll believe it when I see it. Next week, we're going to get a lot. Inflation numbers, job opening and labor turnover, jobless claims, as well as the weekly update from ADP. Hopefully, we also have some good news on peace in the Middle East. I'll see you next Friday.